All right. Good morning. Good morning. How's everybody doing? Beautiful Monday morning, ready to get started once again. Glad to have you all here. Jay's number one today. It's not a race, Jay, but you are a new contender for first place, even though it's not a race. And Gary Thomas coming in second. How you doing, Gary? It's good to see you guys up and early this morning. We got a great class for you planned today, so I'm looking forward to that. Hey, there's Michael Bruce coming in at the bronze level. It's not a race, guys. It's not a race. But it's good to have you guys come in, show up, say hello. Jay, Gary, and Michael. All right, let's get started here. First thing is on the little marquee out front, when you walked in through the movie theater and you looked up, there was a little thumbnail marquee, right? That little thumbnail marquee. What is it that we're going to do today? We're going to talk about several things. We're going to talk about markets can go up, markets can go down, and markets can go sideways. All right. There's only three things a market can do: go up, down, and sideways. In the process of going up, down, and sideways, it can go up, it can then go down, it can then go sideways. And then it can go down, then it can go up, and then it can go sideways. Then it can go sideways, and it can go up, and then it can go down. Then it can go. So there's any combination, many combinations of what the market can do. So, but there are different ways that we make money when a market goes up, down, or sideways. So on my little sheet here, you can see that when a market goes up, there's three tools basically that we have at our disposal to make money. One is buy a contract. Okay. If we're in the futures market, we buy a contract. Now, I know it goes to when they're in the futures market, we call them contracts. And when you're in the stock market, oftentimes in the stock market, we'll call them options contracts. I have to get away from saying that. I don't want to say that. I don't want to use that terminology. A lot of people use that terminology. We got to stop saying that. Okay. When we're in the stock market, people who are in the stock market don't ever think in their head about the futures market. They don't know it exists. All right. In their mind, it doesn't exist. So they call they call options contracts. Well, over in the futures market, we have contracts and we have options. We don't call options contracts. So if you're in the stock market, technically speaking, you shouldn't call an option a contract, because a contract is something that you execute in the futures market, which is not an option. So that's just a little terminology. And so for our forum, for our group of people, for our knowledge base, you need to understand that there's going to be people out there call options contracts. But we don't do that here in this class. All right. We stay a little bit more pure to the nature of what the markets are, because we have contracts mean something else. To us, that means a position in the futures market. So just be aware of that. And for us, we're not going to call options contracts. Now, I do it on occasion, so I have to be careful myself, because when I'm in the stock market, I have to be careful and not call options contracts. But in our forum, we're going to try and stay away from using the word options for contracts. All right. Contracts means a futures position, a position in the futures market, on the futures market over in Chicago, out of the Chicago exchanges. All right. So that's one way we can make money when markets rise. There's Bruce checking in with us. How you doing, Bruce? You're in fourth place today, although it's not a race. Jay beat you to number one today. Gary Thomas was in number two, and Michael Bruce is in number three. We got Bruce in here in number four. We got a whole bunch more people watching the class than what's checked in. If any of you other guys want to check in, I'll make you famous. I'll put up your little marquee there and say hello to everybody. But nonetheless, what we've got, so we got that little confusion out of the way. Buy a contract. That's in the futures market. All right. We can also, in the stock market, we can buy shares. When the market goes up, we can buy contracts, we can buy shares. There's also a way of making money when a market rises, which is buying the call option, right? Now, there's one that a lot of people don't think about. When a market rises, you can sell a put option, and that would make you money if a market rises. All right. Now, there's different rules for these different things. You know, contracts are a little bit different. Buying shares a little bit different. Buying call options a little bit different. Selling put options a little bit different. There's different rules for each one. That's why you need to come to this class, because in this class, as most of you know, this is a lab for the university class that I teach. I'm a university teacher. I teach at the university, just so that I can throw this up on the little marquee here. My name is Lan Turner, former instructor at Chicago Mercantile Exchange Education Centers and the Board of Trades Education Center, and I'm currently an instructor at Utah Tech University. So I teach these classes online for the purpose of helping our students. And of course, the whole world is invited. Everybody's invited to the YouTube classes, but these are supplemental to the classes I teach at the university. So if you're fortunate enough to be in an area where you can come to the university, now I do teach some classes online. So you can, and this fall, we're going to have online classes and in-person classes. So if you guys want to join the classes online, you can join online classes at the university and come and join, and you don't have to be in the physical location where the classes are taught physically at the university campus in St. George, Utah. All right. So that's who I am, and that's how we're running this class right now. So this is for anybody who's in the learning and education mode of the financial markets. If you want to learn how to trade, and the whole idea of my concept of the way I teach people is we learn concepts on how to make money as a income replacement. All right. That's my goal. I want to primarily focus on income replacement. And then what do we do with that money once we have it? Once we've made the money for the income replacement, where do we invest it? Where do we put it? So that's the other side of what I like to teach, because that's what I do. I like to teach what I do. All right. I've been doing this for 30 years, and it's basically what I do. I use trading as an income replacement and as a supplement to my other income. I do have other incomes, not the only thing I do. So I trade part-time, I guess you could say. It's a part-time income because it's not my full-time income. I don't live off it 100%. I have other income. I would expect you would have other income, whether that's real estate, investment properties, whether you actually have a real job, or whatever you do for income. You have an income source. This is going to be supplemental. Now, if you could get to the point where it can be your full-time income, great, boldly for you. That's wonderful. But I wouldn't advise that. I don't think you want to live off of your trading acumen 100%. You want to take the profits you make here, move them into other assets, other places where you can make money. Now, one of the fallacies about this world is that we want to make money in some means and turn it into what we call fiat currency, right? We want to turn all of our assets that we do or whatever we do and collect as much fiat currency as we want. In my opinion, that's absolutely backwards of what it's not only backwards, it's bass-ackwards. All right. That's not what we want to do. We do not want to turn our skills and our acumen into fiat currency. The last thing you want to hold on to is fiat currency. You want to earn fiat currency and then take that fiat currency and turn it into assets. All right. Because assets return value. Fiat currency devaluates the minute you buy it. It's like an option. Those of you who know options, the minute you buy a call option, it immediately begins to decay. Well, the minute you earn a fiat currency being the US dollar, New Zealand dollar, Canadian dollar, I don't care. You name the dollar, but we're going to talk US dollars here. The minute you buy, or the minute you earn, or you have, somebody gives you for one reason or another a piece of paper that stands or represents a fiat currency, it immediately begins to decay in value. All right. It immediately begins to lose value because of inflation. All right. And so the US dollar has continually ever since they devalued it off the dollar, it's become a devaluing asset. So it's not an asset, basically it's a liability, because the minute you buy it, it begins to lose money. So you need to convert that asset, or that fiat currency, into an asset that rather than depreciates, appreciates. All right. So our whole goal here is to come to the financial markets, take the money away. We're like little thieves. You hear me say that all the time. We're like little thieves. I've been calling us, like, I watched what's that little movie? The Hobbit. Bilbo Baggins, right? He's a thief, right? They hired him. They brought him in. They take him they're going to go and steal the jewelry from the big dragon, right? And so they brought him in because he's a thief. He's quiet. He can sneak in, take the money away from the dragon. And so that's what we are. We're like little thieves of the market. We're going to go into this little world of the financial markets, the stock market, and we're going to steal as much money away from those thieving bums out there in New York as we possibly can, or in Chicago. All right. So we're thieves. Our job is to steal as much money away from those giant corporations that own all this stuff in the first place as we possibly can. And we want to take that, and we want to take it, and we're going to convert it into fiat currency, right? That's what we're going to do. We're going to put up a little performance bond. We're going to use that money to turn into fiat currency. And then we're going to take that fiat currency and we're going to turn it into assets that we can live off of and eventually return us income. Now, whether that's in the stock market, buying bonds or stocks or other types of investments, those are the things that we want to do with it. We want to take it out and buy real estate. We can do that. There's all kinds of things that you can do with your fiat currency to put it into assets. You can put it into gold and silver, put it into Bitcoin. Bitcoin's an asset, believe it or not. So these are assets that appreciate in value. Now, of course, they go up and down, they fluctuate. Real estate goes up and down, everything fluctuates. But over the long period of time, because of the depreciation of currency, the depreciation of the asset or of the fiat currency, inflation, other assets will increase in value while the fiat currency will decrease in value. So you don't want to hang on to the fiat currency. Don't think that you're just going to earn a whole bunch of money, stick it in the bank, and then live off of it. That's the worst thing you can do. You got to have assets. All right. So that's what we're doing here. We're trying to steal money away from Wall Street, turn it into fiat currency, and then take that fiat currency and turn it into assets. So we want to hold as little fiat currency as possible. And our assets, we want them to return a consistent income to us, but we need to somehow get fiat currency in the first place. And so I teach methods to turn the financial markets into fiat currency so that we can then redistribute it into assets. And so when the market goes up, we can buy contracts in the futures market. That's one way we can generate fiat currency. We can buy shares in the stock market. That's another way. We can buy call options. That's another way. We can sell put options. All right. Selling put options will make you money when the market rises. All right. Now, if a market goes sideways, that's a difficult time to make money. It's difficult to make fiat currency turn that into currency, right? But there are ways that we can make money when the market goes sideways. One is we can sell a call option or we can sell a put option. Those are good ways of making money when a market's dead and going sideways. Now, markets oftentimes are dead and go sideways, right? So we can do that. We can take advantage of markets that are going dead and sideways by selling call options. All right. So we teach that here in this class, and we've been doing a lot of that. And we did that on Friday, and we did it both in the classroom account, which we trade in demo mode, right? When we're learning and practicing, we do it in demo mode. I also have my own real money accounts. And so on Friday, we've been studying very hard. For those of you who are new, we've been studying very hard on an option strategy that's been working very well for us. And I also did that option strategy in my own personal private account, the real money account, and it worked like a charm, just like the demo account's been doing. And so I made money, real money, on Friday. But I want to show you those trades. I've got a whole bunch of screen captures. I want to show you what happened. And what we did is we did that neutral market strategy where we sold calls and we sold puts, and we made money from doing that. All right. So I'm going to teach you that strategy today, or at least cover it to some degree. It takes more than just one class period, right, to learn. You guys need to come back more than once. So given that, why don't you go ahead and, while I'm thinking about it, like and subscribe this video. Give us a little thumbs up if you like the conversation we're having so far, and then you'll have another opportunity to hit the thumbs up again later, because I've got to teach you lots more stuff. But go ahead and subscribe. For those of you who haven't subscribed, a lot of people come and watch these videos. YouTube gives me stats. A lot of people watch the videos and they don't subscribe. So subscribe so that you get notified when we come and do these classes. All right. That's very important. So we'll talk about that right now. But back to our lesson. What we need to do when markets fall, there's ways that you can make money when markets fall. First thing you can do is you can sell or go short a futures contract. All right. And in the futures market, one of the great things about the futures market is it's just as easy to go short as it is to go long. There's no borrowing. There's no interest you have to pay. If you want to go short shares in the stock market, which you can do on occasion, there are stocks that you can short. Now, not all stocks are shortable. You have to wait to see if there's a little marker on your screen that says easy to borrow, because you have to borrow stock before you can short it, which means you have to pay the dividends and you have to pay interest. You have to pay interest on it, and then if it pays dividends while you short it, you have to pay those dividends back as well. So there's penalties for shorting market in the stock market. There's none of that over in the futures market, which is one of the reasons why we love the futures market and we want to be a part of the futures market for day trading, because it's a great place to turn that opportunity into fiat currency. All right. We can turn the futures market into fiat currency, in my opinion, way easier than we can turn stocks into fiat currency. Okay. So the other thing is that we can buy a put option. So if you think the market's going to fall, you buy a put option, you make money when the market falls, and then you can also sell a call option. right? If you sell a call option and the market goes down, you make money. All right, that's how that works. Now, I'm not going to go into the intricate details of each one of those strategies right now, but we are going to go in and we're going to demonstrate some of those in our class today. But mostly, we're going to focus on that option strategy that we've been experimenting with. And I'm going to pull up those screens and show you what happened on Friday, and then we're going to set it up and see if we can't do another one again today. Market's moving, as you can see. We'll pull up this chart. So you can see that the markets are moving pretty fast right now. That's the S&P 500 up in the upper left-hand corner. This is the futures market. I do prefer to run this option strategies in the futures market because we are working over here in the futures market. We're working with what we call European style options in the S&P. Whereas if you go over and you trade the same strategy on something like the SPY, that's an American style option. Now, there's advantages and disadvantages of that, a little bit beyond the scope of this class right now. We can talk to you a little bit about what the American style and the European style options are, but basically European style options are settled at the end of the life cycle of the option. Then you can't settle them out. You can't have them called away from you. You can't have your positions called away, or you can't exercise in the middle of the contract. All right, that's an American style. So if you're overdoing this strategy on the S&P 500 or the SPY, for example, and you're selling options, you can actually have your position called away from you, and that's not something you really want to do. And the other thing is that when they settle in the futures market, they settle to cash, as opposed to in the stock market when you're doing the SPY, they settle to the shares. And so that's another thing. You just have to deal with the shares and when it settles out, as opposed to just get the cash in your account. So it's a little easier to do it in the futures market, a little bit more efficient. And so that's why we like to do these strategies where we're selling premium and collecting premium on the S&P 500. We like to do that in the futures market. Now, the SPX over in the stock market also has European style options that can only be exercised against you at the expiration of the option. I don't want to call it a contract, options contract, but it is an option. So it can be exercised on the SPX. And so then that's the same. It also settles out to cash. All right. So you have the SPX over in the stock market, but it's 10 times bigger. So it's a big, huge market. You might be beyond the scope of some people what they want to trade. So you have to take that into consideration as well. What does your bank account say? Are you allowed to, are you able to go and trade those bigger markets? So we kind of like to do it over here in the S&P 500 here in the futures market. And that is a great place to trade these neutral option strategies that we traded on Friday, and I want to review with you today. But before we do that, I just want to talk, the morning bell fired off there about 15 minutes ago, and so this is what we're looking at. Up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the Dow, and it's running on a range bar 6. And then down in the bottom left-hand corner, we have the Russell 2000, and it's running on the range bar 10. Now, we've got some class members who are regulars with us, and so some of them make suggestions on what to do and what to trade and what things are like. So right now, up in the on the bottom left-hand corner, we have the Russell 2000, and that funny indicator that's laying over the top of it is the Ichimoku Heiko Kinko. And we've got one of our members likes that tool, and so he asked us to turn that on. And so that's why that's on right now. And also over here on the NASDAQ, this is the NASDAQ down in the bottom right-hand corner. We have the micro mini. This is the range 25. And so this is a range bar, but it's the open high-low close. Michael Bruce said that he liked, that's Matt Baker. In fact, there he is saying hello. Matt's the one that said, why don't we turn on the Heikinashi for a little while? Or the Heiko. It's not the Heikinashi. That's what the bars are doing. What's the name of that thing? I always can't say it. Ichimoku Kinko Hayo. There it is. So Matt's asked us to put that on for now for a little while, and we'll kind of watch that. We kind of like to watch new things every now and again. And so that's the indicator we're looking at on the Russell 2000. And we've got that running on the range bar 10 right now, Matt. So we're looking at the range bar 10 on the Russell. The NASDAQ has open, high, low, close bars as opposed to the candlestick bars. And I think it was Michael Bruce said, hey, I like those. Let's look at those for a little while. So that's why we've got those kind of running over here. But we are looking at Heikinashi. Heikinashi bars are a form of, I guess you could say they're a form of candlesticks. but they also run on the open, high, low, close bars as well. So we do have Heiken Ashi running on the open, high, low, close bars here in Track and Trade. So the software we're using is Track and Trade. For those of you who don't know, we got new people joining all the time. We're using Track and Trade, and the software here, I'll pull it up just real quick. I thought I had it. Maybe I don't. I thought I had a little thing that tell you where to get your copy. I do. It's right here. So you can run and get your copy of Track and Trade. And I'll give you a little link right here real quick while we're watching it pull up. This is the software I'm using. It's called Track and Trade. It's the 7-time Stocks and Commodities Annual Reader's Choice Award. And so this is the software. You can go get it over at trackandtrade.com, download it, and come and join us over here, install it, and you can do the things that we're doing here. So that's the futures version. If you want to do what we're doing here in the futures version, get the futures version. We also flip over. We do a lot of stuff in the stock market. We like to trade stock options, and I show you my stock option strategy in this class. So go ahead and get the stock options version or the stock version while you're at it, and you can join us here in the class using the software and the tools that we're using. So these are Heiken Ashi bars, all four of these. So these are the indexes in the futures market, again, out of Chicago. And I've also got I've got this wonderful little document. I went, for those of you guys who are aware, you are aware, I've got this great document. Okay, it's called my Beyond Fibonacci Advanced Strategies and Insights. It's really the slides that I have in this class. You can see all my slides over here. So they got all my different things that we talk about in this class. And people want to have these slides all the time. They're like, hey, Lan, you talked about that Heiken Ashi color changeover strategy with open, high, low, close, or hey, what about that triangle formation? Or what about that intercept tool that you were talking about? Or hey, how about that triangle pattern that you looked at there? Or what about the cat's meow? I want that, we talked about that in class. I'd like to have these slides. So if you would like these slides, this is my slide deck for the class. All right, there's all kinds of really neat stuff in here. You can see all these different slides that we use for the different lessons. And so if you would like all the lessons, the slides for the lessons that we have here in class, that's it right there. I set it up this weekend so you can go get it online. It's called Visit Me Online at pitnews.com/store.htm. You go in there, it's free. You just click on it and that can get it. Or if you got your you can take your little cell phone thing here and you can scan that QR code on your phone and that'll bring it up and it'll put it on your phone. You don't have to give me your name, your phone numbers, nothing. I'm not asking for nothing. You can have these slides. They're free. And I mean 100% free. I don't even ask you for your name. All right. So go ahead, get the slides and follow along. That's what they're for. They're meant for you to follow along with me in the things that we do. And so you can have those as your notes afterwards. All right. So it's a lot of work. I put a lot of work into these. And so our new lesson today was on markets can go up, down, and sideways. And that's what I wanted to share with you today. This lesson that there's multiple ways you can make money when markets do things. And we kind of use all of these. And this is what we learn in this class. And we're going to review some of these things today. And there you go. So that's how you can go get that free document and you can follow along with me and have those slides. I want you to have the slides. I'm not even going to put them behind some kind of a restrictive barrier that you have to give me your name and email address to join. All right. So here you go. This is the market starting to fluctuate a little bit down here on the range bar or on the Russell 2000. And it's starting to turn and starting to rally down there. How can we make money when markets go up? Matt, I'm going to turn off your overlay, your Ichi Kinki Hayo. It's coming back into the cloud, but right now I'm a little bit more interested in what it's been doing with this pattern here with the color changeovers. So as this market comes up, I want to see it give us a little bit of a pullback, maybe a little, let's see, something like this. Maybe a little pullback, and then we can get another rally out of it. All right, this market's coming up. We don't know if it's going to turn and go back up or if it's going to just continue to fall or if it's going to go sideways. All right, that's your decision point. See that right there? That's the exact spot thing that we just drew on the screen, right? Do we think the market's going to go up, down, or sideways? It can do one of three things. It's called a decision point. All right, I call these points where a market gets to one of these decision points. Now, this is obviously a market's going up. This is a market's going down. But right here, when it makes this changeover, It could go up, it could go down, or it could go sideways. It could fake up, it could go sideways, it could fake up and turn and go down. All kinds of things it can do, right? So we have to make a decision at what we think this market's going to do. So we can look at these other markets. They all seem to be wanting to go up. Do we think this market's going to follow and go up too? Or do we think it's flush and fall down, and then these markets will turn and follow this market down? We don't know. Or maybe it'll just wander and not do either one, go up or down, and just go sideways. So this is day trading, and these are individual small time frames. Of course, this is a range bar 6, so there's no time involved. This right here is nothing more than just 6 minimum moves that the market has to move before you can get in, or before it'll make a new price bar. So each price bar could be any number of amount of time, just however long it takes for the market to get to a certain price distance. All right. So being in the futures market, for these markets, these 3 markets are all called mini accounts. So if you come over to the key, you can see that a mini account requires a margin amount of $1,000. Actually, it says right now $750. I always just figure $1,000. $1,000 is what you need to put in a position in these markets. Now, let's say you put in your $1,000 and you bought it right at this arrow. If you'd have done that and sold it at that arrow for $1,000, you'd have made 42 ticks or $210. So that'd have been a $210 move from here, which was at 7:41 a.m. to here, which was at 7:49 a.m. So 8 minutes. In an 8-minute time frame, you can see how many bars we got. A lot more of this. These are not 1-minute bars. So a lot, because they're range bars. So they just have to move 6 minimum moves, and then they'll create a new bar. So that went from here at 7:40 to here at 7:49. So in an 8-minute time frame, it made all those bars, and it would have made you, with a $1,000 investment, $210. That's it. Get in, get out. Made $210. Put up $1,000. That's trading here on the Dow in the futures market. Now it's a little different than if you would have been over in the stock market. The stock market, you'd have probably had to put up about $39,000 to have that exact same move and make that exact same amount of money. All right, in a cash account. So that's the way trading works over here in the futures market. That's why I say it's a little easier to turn the futures market into fiat currency than it is in the stock market. Not that we don't love the stock market. We certainly do. It's just a different tool, does things a little bit differently, and we like this market. So this is a lot of fun, and we like to trade this market. Here again, down here on the Russell 2000, if we'd have just got in right here when this thing switched over from red to green, and it's currently trading right there with a $1,000 investment, we'd be up $245. Well, Lan, why aren't you up $245 then? Well, because I didn't get in when it switched from red to green. I sat here and talked to you guys instead. So these are ways that you make money, again, when the market goes up, down, or sideways. How do you make money in the futures market when the market goes up? You buy a contract. One contract is represented by $1,000 in these particular indexes. All right, these are the stock indexes that we trade over in Chicago in the futures market. So that's just kind of the way it is. I know it sounds a little screwy that we're trading stock indexes out of the futures market in Chicago, but that's what we do. All right. There's reasons why we do that. Again, it's beyond the scope of this class. This is a hedging market, a speculative market. And so they like speculators to come over and do this because it helps them out, and they want us here. So they let us come in here and trade these markets. So keep that in mind. So when a market goes up, we buy. When a market goes down, we sell. When a market goes sideways, we sell calls and puts. We collect premium. All right. But right now, we're just looking at these little small time frames, and we just wait for an opportunity. You don't have to feel pressure to get in and out. The whole idea is that we want to just be very gentle, very careful, very cautious. Heck, the market is going to trade for another 6 hours. It's been trading for a half an hour. There's another 6 hours to go, and we don't have to feel pressure to jump in right now. All right. We don't have to feel pressure to jump in right now. If we don't want to, we can wait until a good setup. Well, Lan, I don't know what a good setup is. I'm new to this. What is a good setup? Well, a good setup is what I was talking about with you over here in some of these slides that you're getting for free, right? You're getting these slides for free. And so you're getting these slides for free. But in here's a lot of these little different setups that you can come to, and you can trade these in different ways. These are called, we have a little mantra that we use, right? When we trade: count, measure, set up, trigger, and follow through. Count, measure, set up, trigger, and follow through. What are we counting? We're counting the waves of the market. Markets move through waves. Drive 1, drive 2, drive 3. We know that from past experience that markets have a tendency to move through 3 drives. So we look for 3 drive patterns. So count. That's what we're going to count. What are we going to measure? We're going to measure those drives. What do we use to measure them with? We use a tool called the Fibonacci ruler. Fibonacci is just a ruler that measures Elliott waves, which is what we call those 3 drive patterns, right? So we have count, measure. We're going to have Elliott waves or 3 drive patterns. So we're going to measure them using our our Fibonacci ruler. It's just a ruler. It's all you use it for, is just to measure those waves. And then we have the setup. What is the setup? Well, the setup is these little recurring patterns that happen. And they happen all the time. So you have these little patterns that happen. And then depending on where they're at in the count is your probability of success on these patterns. If you don't know where you're at in the count and you don't know how big those moves are being made, well, the setups are probably pretty rough for you to be able to try to make money on if you're missing the first 2 components. So that's why we have the 5 steps. We have to count, measure, make sure the markets are moving through the waves. Which wave pattern is it in? That's your probability, 1, 2, 3. And how big are they? Are the waves big enough that if you do get in, the markets are moving in large enough waves to make you money? You got to be able to have a market move far enough that you can get your stop to break even and actually make money. And if the markets are waving, but they're not waving big enough, you can't trade. So then we have our setup, which is these patterns. We have our trigger, the breaking of the pattern. That's what gets us into the market. And then another breaking, which is the follow through, getting us out. So count, measure, setup, get in, get out. That's what we're really talking about, right? And this is a great little book, pattern book in here. Now, this is a supplement. Now, this is just a supplement to the overall bigger book, right? So the manual to the class is Land's Playbook of Strategies, all right? Now, this is a 260-page book. It's the manual to the class. If you guys want the manual to the class, you buy it on Amazon. Just go to Amazon and search Land H. Turner. You can buy the digital version if you would like. I'll show you how to get the digital version. It's a little less expensive. Most people just want the paper version, though, because they like to have paper between their fingers. And so you can go to pitnews.com/store. That's what I'm showing you right here, if you can get to it. So go to pitnews.com/store, and you can download the PDF version of the class manual. And it's all these slides right here. These are the supplements. This is a supplement, just my slide deck for the class manual. So the class manual is at pitnews.com/store. You can buy it there, or you can just go on Amazon and buy it. And I would recommend, if you like the paper version, just go get the paper version on Amazon. Just search Land H. Turner on Amazon, and this book will come up, and you can buy the manual version, all right, the paper version. And then you got the manual, you got the software, you got the supplementals, and you got me working here with you. You can come and join us at the university. Don't forget to get the software. And then we follow up with all this great stuff with Pitt News Magazine. Pitt News Magazine is where we publish all of the work that we do here in class into a magazine. We then record it so that you can listen to the articles. You can read the articles. We have videos that go along with it. And this is Pitt News Magazine. I'd recommend you get Pitt News Magazine because that's kind of the follow-up. That's where we publish all of our research. All right. So you want to have that. And it's only $1. You just go over to pitnews.com. Pitnews.com. It's $1 for the first 3 months, 3 issues. And if you don't like it, you can cancel. Otherwise, it'll be $49 a month after that. Or not a month, $49 for the entire year after that. But it's $1 for 3 months. So you get 3 issues for $1. And that's where, again, we're going to publish all of our work that we do here. Because we're only together for 1 hour a day, right? And how many of you think I can teach you to be a professional trader in 1 hour a day? It's tough. So that's why there's all this supplemental information that helps you. And we stay together as a nice little community. And I try to make as much of this stuff either as cheap as I possibly can or free. And so trying to help you guys out. And that's why it's on YouTube. YouTube is free. All my time is free. I'm helping you. All right. So there we go. And look at that Russell go. That Russell's really doing well today, making me have a little FOMO, fear of missing out. That market didn't ever give us that little rebound, did it? And never did come back and go back up. We can turn off Heiken Ashi. We might have got it without there it was right there. There was our little red to green right there, little continuation, and we had Heiken Ashi turned on, so that little tiny marker right there didn't show up for us. So turn Heiken Ashi back on. There we go. All right, what happened here? We were looking at this little pattern right here, and we were saying that was a decision point, whether it was either going to go up, it was going to go down, or it was going to go sideways. Well, it looked like it went down. We had another decision point. Here's another decision point right here. Okay, it's just like, oh, you guys can't see it. There it is. So here we are looking at the range bar 10. Range bar 10. I turned off Heikin-Ashi. There was our little, on the range bar 10, there was our little signal right there from red to green. But we had Heikin-Ashi turned on, so we couldn't see it. So Heikin-Ashi is like that. So we kind of missed that little spot in there due to the indicator we got turned on, but it kind of tells you it's kind of a nice little indicator in itself. So then we have our, just like we were looking at over here, again, there's your up, down, sideways, right? That's called your decision point trading. So whenever you got a market like this coming into a decision point, that's the decision point that you're going to envision in your head, all right? So a market can come into a decision point, and anytime it changes color from red to green, you get a red to green, that's a decision point. The market can that point go up, can go green, it can go sideways, or it can go down, all right? And you kind of have to wait for it to decide what it wants to do. If it goes from red to green, you're like, well, I'll just buy right there. Okay, that would have worked really, really wonderful right here. All right, red to green, up it goes, make a lot of money. Red to green, here it goes, up it goes, make a lot of money. Here it goes, it failed. Doesn't work every time, but it's a pretty good indicator with the way we got these tools set up, right? So you kind of want to watch and see, and there's other ways that we can read and count markets, but nonetheless, we're looking for these little, and that's why I call them decision points. And a decision point is where the market's going to make a decision on whether it's going to go up, it's going to go down, or it's going to go sideways. And you need to decide whether you think it's going to go up, down, or sideways, and that's where you place your order. So now we come in, here's another decision point right here. We went from red to green. Is the market going to go up? Is it going to go sideways, or is it going to go down? You just need to decide. All right. And you don't have to take a big risk. Now, this is what I call the 33, 33, 33 rule, right? So you got 33% chance of being right. Why do you have a 33% chance of being right? That's right there on that window again. How a directional trade each move in the market rule of 33, 33, 33. Why is it 33, 33, 33? It's 33, 33, 33 because, well, you basically have 33% chance it's going to go up. You have a 33% chance it's going to go sideways. And you have a 33% chance it's going to go down. So anytime you make a decision, you come to a decision point. Here's another one right here, another decision point. Red to green, green to red, decision point. Is the market going to go up? Is it going to go up? Oh, why in the heck can't I get an arrow? Give me an arrow. Is it going to go up? Is it going to go sideways? Or is it going to go down? That's a decision point. You've got a 33% chance of being right because you got a 66% chance of being wrong. So that's why whenever you have a decision point and we say get into the market, you want to be really careful. You want to just get in, and if you're wrong, then just get right back out. Don't stay in there and expect it to come back for you. Wait for another decision point. All right? You wait for those decision points, and if you're wrong about your decision, just get back out and wait for another decision point. That's the biggest problem people have. That's why they lose money trading, is because it comes to a decision point. They have a 33% chance of being right. They're wrong 66% of the time, but yet they think in their head, I'm right and I'm not getting out. It'll come back. I know it will. I know it'll come back because I can't be wrong. I'm so right. I just know I'm right. I'll just wait for it to come back. Don't do that. Don't do that. That's the quickest, surest fire way of losing money. All right, we got red to green. Is it going to go up? That's a green saying it should go up. But now it's going from red, it's going green, it's going back to red. So what do we think the market's going to do? Now we got other tools that we can use. We got moving averages. We've got all kinds of indicators. Again, one of the indicators that we were talking about earlier, Matt likes Ichimoku Hikahinko. We could use that one, right? There's all kinds of tools that you can use to help you make your trading decisions and decide when you get to these decision points, whether you're going to get in long, whether you're going to get out, whether you're going to get in short, whether it's going to go sideways, whether you want to, what are you going to do? But those are the points in which you want to make your decision for entry and exit. Now the market's starting to go sideways, isn't it? We come to this decision point right here, and the market started to lose its mojo. said, hey, first of all, it went green, like it wanted to go up. And then it went from green to red. So, I think I want to go down. And then it didn't go up or down. So what's it doing? It's going sideways. So have we lost all of our energy in this market? Has the market stopped going, moving? They're making nice little trends there, but now it's just kind of looks like it's dying out, doesn't it? So what's going to happen? Here's a better market. Seems to be moving a little bit better, doesn't it? So what are we going to see happen on this market? We only got one nice decision point back here, and it took off and went to the moon. How much money would that be? Well, with our $1,000 investment from there to there, that's $300 right now. It's sitting there at $400. That's a $400 move. How much time? Well, that was at that decision point came in at 7:46 and went to 8 o'clock. So in 15 minutes, that was a $400 move with a $1,000 investment on that decision point. Okay, here's another little decision point. Now, this decision point came in right here, right at the top of the hour, right? So right when right at the opening bell when the market opened. So this market was just going sideways before the opening bell. The opening bell rang, boom, and it turned and decided it wanted to go down. So that was a decision point. It could have gone sideways, it could have gone down, it could have gone up, but it went from green to red, became a decision point. All right. So always think about decision point. What is the market's decision? And how can I make money? If the market's going to go up, we're going to buy a contract, we're going to buy shares, we're going to buy a call, or we're going to sell a put. Market's going to go sideways. The only thing we can really do if market's going to go sideways, we can sell a call, we can sell a put. Now, we're day trading right now. So these are little tiny time frames. So we probably want to be careful with our options selling strategy because we want to wait for that to be a sideways channel for a longer period of time. All right. These are little tiny moves. So little tiny moves like this, we probably don't want to play the sideways market. We want to avoid that market. We just want to take the shorts and the longs. So if the market's going to go up, we're going to buy a contract. If the market's going down, we're going to sell or short, sell a contract. All right. We can sell first and buy back low later, but the market's got to go down. All right. If we sell, the market's got to go down to make money. So we think the market's going to go down. Then we get out. Okay, it's making decision points. It's kind of going sideways, isn't it? But it's been going up for a long time. Might be a good chance it's going to go down. So how do we do it? Well, we sell. Okay, we just sold. I don't have to own it to sell it. Not in the futures market. Why? Because I'm going to buy it back low later. So if the market's going to go down, well, there it goes. That's a decision. I have a 33% chance of being right. Now, it started to go down. Doesn't mean it has to continue to go down. It could go down a little bit, come back up, and start to go sideways, or it could come down and go back up. So if it does that, I want to get right back out. I don't want to stay in there if it's going to turn around and go back up. So I take one of these orders here. It's called a stop order. And I just put it right in there. I just put it real close. If it doesn't immediately just go in my favor, I just get right back out. Take a little tiny loss. All right. Doesn't have to be a big loss. It could be just a small loss. Just says that, hey, our 33% chance of being right was wrong and we got out. Just get out. All you have to do is wait for another decision point. And then if you're right, stay in as long as you're right. Right? And then cut your losers short, let your winners run. That's the name of the game. That's really all we do is we just trade decision points. I call it decision point trading, right? And there's lots of little decision points. That's what this whole thing's all about. This whole little document that I'm showing you here is all about. And of course, all the rules are in the manual out on Amazon, lanhturner.com. Go search that for all the rules. Teach you what all this stuff is. These are just the slides that go along with our classes. So I want you to have this slide. Oh, see that? That market changed its mind. It decided it didn't want to go down. Another decision point. Red to green. Is that bar green yet? Not yet. Well, it's trying to go green. We'll wait for it to close out. Make sure it's a green bar first. Red to green. There it is. Okay, we're going to take that one. We don't have to because the market might be going sideways. We might not want to take any trade. But if we think it might continue to start going up, but I'm going to drop an order in here right on that little yellow dot. See that I got this button here programmed to put it right on that yellow dot. So I'm going to put it right on the yellow dot. And if it hits that, turns around and decides it doesn't want to go up now, right? Didn't want to go down. Now, looks like it's trying to go sideways. But if it doesn't want to go up, I'll just get right back out again. I got a 33% chance of being right. And if I'm wrong, I'm done. Okay, I tried twice. For me, I don't want to keep going. That's good enough. The market's proved that it doesn't want to go up, it doesn't want to go down. It just wants to go sideways. And I can't make money when it's going sideways. So I'm not going to trade right now. Wait for it to break out and start to prove that it wants to go up or down again. Now, this is another decision point. But if you try to take every single little decision point during a sideways market, that's where you get your hiney handed to you, right? So like right through here, see all these little decision points back and forth, back and forth, back and forth, back and forth, back and forth. And so you take all these little cuts, or what we call, death by a million cuts. So that's what kills your account, trying to go in and out, in and out, in and out in a sideways market. So we have to be smart enough to know, well, we tried twice. We tried to go up, that failed. Try to go down, that failed. That must mean the market doesn't want to go up or down. It's just going sideways. Doesn't mean it can't start going up and down again. It certainly can. So if it starts to go again, we'll wait for it to go maybe 4 bars this time. We want it to prove that it's going to go in our favor. And then we'll look for a little pullback, a little green bar, and then another continuation. That's called an ABC pattern. Again, that's in here. It's one of the patterns that we have in our little booklet over here. And so there's different ways that once you start to trade that you can decide, hey, I want to be looking for this little pattern here. See a little rally, a little pullback, and then we anticipate a continuation of the trend. So that's one pattern we like. Now it's trying to go down. We got a little arrow there. We could take it again if we want. We think it's going to fall. I want to get rid of those. So if we think it's going to continue to fall, we could try again. All right. We'll put our order in there, get out if we're wrong. If it doesn't want to keep going, we'll just get out one more time. But each time you do this, you lose money if you're wrong, right? You got a 33% chance. Each time you get in, you got a 33% chance of being right. It can move in your favor. It could go sideways, or it could just turn around and go the other direction. 33% chance of being right. You need to catch one that's doing it right so that you can make back the money that you lost trying on the ones that didn't work out. And that's the whole name of game of trading. That's all there is to it. Sorry, Matt. Sometimes I appreciate you throwing that in there, but I need to get back to looking at that chart a little bit more often over there. Check it. I need a buzzer or something. Jay's saying that mostly it's all about patience. That's it. Wait for those decision points, Jay, and decide whether it's a good enough one for you to want to take a risk to see if the market's going to move in your favor. If it is or if it isn't. That's really the whole name of the game. Just wait for the decision points and then decide if it's a setup or a trigger, or, if it's good enough one for you to trust putting it on there that you might make a little money. Do you think the market's going to move far enough that you can get your stop move to break even so that you don't lose any money, and then let it run? It's all about a 33% chance of being right. And you just realize that that's all you got. You got the market working against you 66% of the time. That's why we just want to get out if we're wrong. Just get out. If it doesn't just keep going, making lower highs, lower highs, lower highs, lower highs, or higher lows, higher lows, higher lows, higher lows, just get out. Yeah, it's just going sideways. The market's not doing anything. Look, we've tried 3 times now. We're down $134. So the market's going to have to move quite significantly for us to find one that's going to make enough money to get us back. That's $450 move. It's not hard, to make the money if you can catch a mover. But, you got to know the biggest key, the hardest thing about trading is knowing when to get in, when to get out, when to take trades, when to not take trades. You're going to get a decision point and you're going to get in, and it's not going to work, just like us. I mean, this is a perfect example of what happens. What we've got to do is, as a trader, you got to know when to not put your orders in there and think you're going to take every single little breakout. All right. Every little decision point isn't always the best time to be getting into the market. You got to have usually we need a catalyst, something that's going to make the market move. And if we don't think that there's a catalyst that's going to make the market move, then we don't want to be getting in. The problem is you try and get in, and then you say, okay, I'm not going to get in. And then that's when the market takes off. It's a carnival game. It's a carnival game, right? The markets are here to fool you and take your money. Remember, we're little thieves. We're trying to take money from Wall Street. That's what we're doing in here. We got our little trend lines. We can draw trend lines, and, where do we think the market's going to break and all that kind of stuff. But really all it is just decision points. Wait for a decision point and decide whether you think the market's going to go or not. You got other indicators you can look at. You got the MACD, the stochastics. Am I in a overbought, oversold region? is the MACD high, is the MACD low. There's all kinds of mathematical models that we can use, and we talk about all those. All right. So here it is. It's gone from red to green. Do we think this one's going to move high enough to get us to break even to where we can make some money? If we do, we can try and take it again. You want to try and take it again? Sure. Let's give it a shot. We're in a demo account, so we just want to practice, right? We want to see how well this is working. The biggest thing you're going to learn in a demo account is oftentimes when not to trade, right? Well, it didn't break our little yellow lights, so we're going to hold on a second and see. That's a fake out to the upside. Is it going to fake to one direction and go the other? The question is, when's it going to start moving again? Nobody knows. So you say, well, I'm not going to get in now. It's dead. I'm going to wait for it to start moving before I get in. If you take that approach, then what you're going to do is you're going to wait for it to go 2, 3, 4 bars, make sure it's actually trending again. And then when it makes a little tiny pullback, and then you're going to anticipate it's going to trend again. So that's called an ABC pattern. That's one of my favorite moves. But the market's got to be moving far enough to make it worthwhile. And right now it's not. It's kind of dead in there, right? Let's go look at what the other markets are doing. Here's the Dow. Here's the NASDAQ. And one thing, we have a catalyst that shows us what we need to be trading. And a catalyst is oftentimes a news event, right? Something that's going to make the market move up or down. So this is our news events. And so you can see here on tradingeconomics.com calendar, this is where I like to come to find out if there's any news events. Now, at 7 o'clock this morning, we had Fed Jefferson speak. And then at 9 o'clock, consumer inflation. Now, this is my time because I'm in Utah. Remember, I'm UTC 6, so you're going to have to make adjustments for your time. Usually, I'm not really impressed with anything other than 2s and 3s. So there's really nothing in here for today. Today's going to be a really dead, quiet day. No big news. Nothing going to move the market. Look, tomorrow at 6:30 in the morning, we're going to have PPI. So that's going to be a good one. That'll move the market. Producer Price Index, right? So that's the PPI. And so the Producer Price Index is going to go off tomorrow at 6:30 in the morning. So market's going to move 6:30 in the morning. Are you going to be trading at 6:30 in the morning? That's my time, Mountain Time. So that'd be 8:30 in the morning Eastern Time. And then as we come down, what's some more? We got a couple more. Market opens at 7:30. 8 o'clock, we got an old Fed Chair spouse speaks. That's going to be a big one. So tomorrow is going to be a big day. And so once you get used to kind of seeing what these news events are, you can say, hey, wait, the Fed's going to speak tomorrow. That's going to be a big one. So the day before the Fed speaks is oftentimes a quiet day. Market will go sideways, be very quiet this day because tomorrow is going to be a big moving day as they wait and anticipate what's happening tomorrow. So today might be a good day to put on a neutral option strategy, right? So it might be a day where we can say for the rest of the day, we can anticipate the market's not going to do a whole lot. It's going to go sideways. So we could go put on our option strategy to sell the call and sell a put rather than sit here trying to go long and short and get our hiney handed to us when the thing's not going to go long or short. It's done. It doesn't look like it wants to do anything, does it? It just wants to go sideways. Try to break out higher off this NASDAQ. You can see the NASDAQ did the same thing. Same pattern, didn't it, right here? So you have this little pattern here of sideways nothing. And then the same time, this market was doing the same thing. Now it's tried to break out to the top. Now this one had the same little thing right here. See this? All this stuff during the same time frame. Market's doing nothing. And it's trying to break, trying to be a little bit bullish, but nope, it's failing, coming back down. The NASDAQ's trying to rally a little bit. It's trying to go up right up out of this little sideways red, green, red, green, red, green thing it did. All right. So decision points, decision point trading. That's what it's all about. Decision point trading. Wait for a decision point. If the market's moving, go ahead and jump in. Oh, look, it's trying to fall right here. It's making a bigger move. Do you think that's going to go? Do you think it's going to continue to fall? If you do, you got a 33% chance of being right. How much are you willing to risk to find out if you're right? That's the name of the game. You put your order in there. We generally say don't chase the A1s. This is called an A1. A1 is your first breakout. If you don't know what an A1 is, go get the manual to the class. It's in there. We talk about it. We lay it all out for you. An A1 is the first breakout. We say don't chase the A1s. Why? Because they fail a lot. Wait for an A2. A2s are much better. All right. So this is an A1. We're going to try and take this A1. And this was an A1. It was a failure. 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 So we have lots of little A1s in here. This is another A1. We're going to try it. We are in the demo account. We're just practicing, showing you how to do this. Put our order in there. Now, if it starts to move in our favor, see those little yellow dots? Those are good places to put your stop order to get you out. So you can come in here and say edit, and we're going to just tell it to trail on the yellow dots, which is the ATR. All right, so it'll sit there right now until the yellow dot catches up, because I got it closer than the yellow dot. Once the yellow dot catches up, it'll start trailing along with the yellow dot. Okay, so you can see right here, this trade is now up $37. Now, of course, we're down $134. So we need the market to move far enough to get our money back. Now, one thing I like to do when we do this, I like to come in here and right-click on the tool. Now, this is Track and Trade. Again, this is a visual tool, a visual trading platform. It's designed for the visual investor. If you like to just work with numbers and spreadsheets, this probably isn't the software for you. But if you like to visually see a representation of what markets are doing on the charts, then this is probably the best platform for you. All right, so you're going to come in here. I'm going to go Add OCO. And notice I can put those orders, the visual represented right on this chart. And you'll notice that there's money associated with them. There's $340. Now we're down to $134. So if I want to try and get that money back, I can bring this line up to where that number over there says $134. That's a limit order. All right, so I'm going to put in there, I'm going to say I'm 134 down. I'm going to put it right at 140. So if it'll come down to 140, I'm just going to get out. Take my profits, get back to break even, and then start doing it again. Wait for another decision point. And then I'm going to have this trailing stop coming in down here. Now, this is another trailing stop because they're attached. I don't need both of them. I can get rid of this one here. All right. And then what I'm going to do is I'm going to tell this one, I'm going to say edit that one, and I'm going to tell it to trail. So it's down here. It's an OCO. This one was the standard order. Now, this is the OCO. I'm going to tell it to trail on the ATR. There's those yellow dots. And it's going to come down. It's going to follow those yellow dots down, and it's going to lock in the profit. Well, it's not even got to break even yet, right? This is down here. We're up $82. And see all these little yellow dots all the way up there? See how the yellow dots kind of come in at the close and just close out the position? So that's why I've got it on the yellow dots. We're just going to let this go down until it closes out the position or until we hit our recovery, which is $134. But land, what if it goes beyond the recovery? What if it goes down here and you would have made all that money and you got out at the 134? Well, for me, that's a good sacrifice. I don't mind. I'd like that. I just want my money back so I can get back to green, get back to zero. Then I'll just wait for another decision point and I'll do it again. Looks like it's backing off. Come on. I don't want to lose some of the money that I've got. Push down there. Come on. That little purple line is like it's called the VWAP. It's kind of like a rubber band. It likes to pull the market back down to that rubber band. So we still got the rubber band is underneath our break-even point. I want to see it come on down. Come on down. Come on down. If I get a little nervous, I can bring that stop in closer so it doesn't lose money on a rebound. So at least I get some of my money back. But if I feel like it's going to continue to fall, I'll just hold it back here and let it go. I want it to touch that blue line. It's like throwing darts at a carnival game. Do we think that the little snaky thing is going to come down to the blue line? If it is, we just hang on. If we don't, we pull that in. So when it backs off and starts going the other way, we still get to keep some of our prize money. All right, touch the purple line, buddy. Come on, you can do it. Touch it, touch it. Give us our full amount. Otherwise, all we're going to get is a rubber mouse. Oh, we got her. There we go. Back to 72 cents profit. Now, of course, that doesn't include commissions and fees. We have to always take into consideration that Uncle Joe Biden wants a little bit of money, and plus, your brokerage firm wants a little bit of money for doing this for you. But, you have to pay those guys too. All right, so got ourselves back to break even. So we got our money back that we lost in there. So now we're in good shape again. I feel good about things. So now all I have to do is just wait for another decision point, take another 33% chance, make sure that my chances are really small. And one of these times I'll be right and it'll go in my favor and I'll make money as opposed to just do recoveries. But that's how you trade. That's it. That's the name of the game. It doesn't have to be any harder than that. Just trade your decision points. All right. So now let's go over and talk about our option strategy. All right. Because as we talked about in our class, we got ups, we got downs, and we got sideways. We bought contracts. We tried to go long. We sold contracts, made money on that one. Now we were going short, right? We're doing a short contract on the futures. We made money when the market failed. So that's how we short the market. We sell first, buy back low later. This is a concept that's a little bit hard for some people to understand how they'll let you sell something that you don't own, but they do. So just don't worry about it. We'll get into the details in later classes on why they let you do that and the differences between stocks going short and the futures market going short. It's easier to short in the futures market. Just keep that in mind. But nonetheless, we made money when the market fell right there, and that's how we recovered our profits. And we did it on an A1. So A1s can sometimes pay off, but generally we try to avoid A1s because they have lots of false breakouts. See that? All those A1s right there. And Lan, what's an A1? What's an A1? Well, we'll get to it in this class, but it's in the manual. Go get the manual out on Amazon. Lan H. Turner, just search it. Get the manual. It's not very expensive. You just saw we just made $150 in a few minutes. I think you can afford a little manual. I got it as cheap as I can get it out there, as cheap as Amazon will let me sell it for. So that book helps you. I think it'll pay for itself in no time. All right, so that's the name of the game. Here we go. Let's go look at our option strategy. So I'm going to come in and I'm going to start bringing up for you the options. Let's move this away for a second. That's our spreadsheet. I'll bring that up. I want to cover that in just a minute and show you what happened after I show you the pictures. So last week we put on the what I call the wild eye, crazy eye, iron butterfly, right? That's what we named it. For those of you who are new here, we call this thing the wild eye, crazy eye, iron butterfly. And so why do we call it that? Well, because it's not exactly like what everybody else does. All right. What does everybody else do? Well, they do normal butterflies. They don't do the wild eye, crazy eye, iron butterfly. That's just what we do here in this class. Now, I spent the whole weekend watching YouTube videos, as I'm sure you guys do. You go out and spend your time watching a few YouTube videos, and there's 10 million kids out there that are trying to show you how they're making $1 million every day trading. Unrealistic expectations, guys. Are there guys making millions of dollars every day? Yeah, there are. Are they kids on YouTube? Probably not. If those kids were making as much money as they claim to be making on YouTube, Wall Street would be knocking and busting down their door to get in and get them to come and work for them. So just keep that in mind. It doesn't mean they don't have something good and fun and interesting to share. They're sharing their experiences. Most of them are making, I would say 99% of them are doing these things in demo accounts, even though they're telling you it's real money. They're probably lying to you. I'm not going to say they all are, because I'm sure there's some out there that are real traders and making real money. But let's just say if they're making, some of these kids, they tell you the most unrealistic, fantastical things. It's like, dude, if you could make that kind of money that you say you're making, trading these markets the way you say you're trading them, I can promise you Wall Street would be on your doorstep. I don't care where you live. If you're middle Kansas in a little hut out in the backwoods, they would find you and they would drag your ass to New York City if you could make that kind of money. All right. So if you're going to put up a YouTube channel and you're going to start teaching people how to trade, I don't know. Hitler said, if you're going to tell a lie, tell a big one, because people are more likely to believe a big lie than they are a little lie. I don't know. Maybe that's what they're doing. And maybe they're smart. They're historians. They know that. Nonetheless, I've made my little rant and rave about other YouTube channels. I'm not saying not to watch them. Just take what they tell you with a grain of salt. Okay? They're telling you their experiences, and it's fun to have hangar talk. I mean, I'm a pilot. And I learned more just going out to the airport and hanging around with other pilots and talking about flying in the hangar than anything else. Now, 90% of what those pilots tell me happened in the airplane, it's probably not all true. Okay. Maybe they embellished it a little bit. You think? You think if a pilot told you a pilot story, he embellished it a little bit? Maybe a trader might have an incentive to do the same thing. That's all I'm saying. But anyway, nonetheless, there are some great guys out there that have a lot to share. And I found a couple of guys that I thought were, pretty legitimate. And I was watching their videos and they were talking about selling iron butterflies. And as many as the legitimate guys as I could find, I didn't see a single guy out there doing the stuff that we're doing here with the wild eye, crazy eye iron butterfly. Now, what's the difference between what we're doing and what they're doing? Well, a lot of those guys get tied up, and you've seen this little graph, and I'm going to show them to you. And you're going to probably say, well, Lan, why have you never showed me these before? These little graphs. Let me pull up my software here, and I'm going to pull up just a chart that I can draw on. I'm going to come back here. Oh, look, that's the market we just took that short position on. It just kind of died on us. What do we think it's going to do? You think it's going to come and turn and fall one more time? It's going to two greens, and now it's going to make another. That's another decision point. You could get in for another short position, see if it's going to go short. Okay, back to our story. You've seen these little graphs, right? Where you have, a butterfly looks like this. And then they have a risk graph that comes across and looks like that. And oftentimes it's in a different color. So you've seen these little graphs, right? These little, options graphs. And they show you, basically break even, where markets can make money. And it's like, why don't you ever show us those, Lan? Well, first of all, this is one of the reasons why I believe that a lot of these guys who trade like this, what's the word I want to use? Myopically, I use that word a lot because people get so focused on looking at this, right? They're looking like this that they never see this. And one of the reasons they're always looking like this is because of that little tool right there. Because that little tool doesn't have the ability to do this. All it can do is this. Does that make sense? I don't know if that makes sense. Hopefully it'll make sense here in a minute. Because our strategy, this is an iron butterfly right here. All right, this is an iron butterfly. That's what it looks like when you sell an iron butterfly. But this little risk graph that draws this, and there's websites that you can go put your stuff into that'll draw these risk graphs for you, and I'll show you one. I'll try and show you one here. Track and Trade doesn't have these risk graphs. It's not that we don't want them. It's just that it's such a low priority that we got other things we'd rather have in the software besides those stupid risk graphs. They're cute, and they're fun to play with. Other software, you can draw your little lines. You can move them up and down and stuff. What does it really mean to the trader? Nothing. They get so focused on that, they stop looking at the chart. Have you ever noticed that? You go watch these guys trade their option. Oh, look, we thought that we had a 33% chance that market might fall. That's the position I was taking. 33% chance to go sideways, and instead, what did it do? Turn and it's going up. Crazy, huh? You just got to be right. All you have to do is just be right. So red to green, there it goes. This was a green to red, and it didn't fall. It didn't fall like we thought it might. Came down, said, nah, like this, saw this purple line, and decided to go back up. Anyway, these little risk graphs, they tell you your myopic view of the profit and loss and the break-evens of your options. Now, when we do it in Track and Trade, again, Track and Trade is a visual investing tool. So they get looking at those little, if you go watch some of these guys, and the guys that I was watching that I said were pretty legitimate guys, I think they were pretty serious about what they were trying to do. I never saw them look at the chart once. Not once. I mean, I watched, there's a couple of guys on there that I watched for literally 3 or 4 of their videos, which their videos were an hour long each. So I probably spent 6 hours. Now I put their time thing on like 2 times, right? So I go into YouTube and I say, turn it up to high speed because I like to go fast. So, but I spent about 5 or 6 hours watching these guys. And I would say I probably watched 3 or 4 hours and never had them even show me a chart. I never even saw a chart like this kind of chart. I saw lots of little risk graphs. That's all they traded off. Oh, we're going to put on an iron butterfly. Oh, we're going to put on an iron condor. Or we're going to put on we're going to put on this. And the only thing they ever showed me, the whole video for 5 hours, were little risk graphs like this. That's all I saw. little risk graphs, you know. That's all I saw the whole time. They never pulled up the chart that we were looking at, never even looked at it. So how do they know the count, measure, setup, trigger, follow through? Right? They're not trading the chart. They're trading an iron butterfly. They're not trading with options. They're trading options. Does that make a difference? Does that make sense to you? They're not trading with options. Okay. Again, they're not trading with options. They're trading options. There's a difference. Now, when you trade with options, you need to know what the market is doing. You need to look at your chart. You need to be a chart expert. You need to be an analyst. All right. You need to be able to look at a chart and say, I think a chart is going to go, it's either going to rise, it's going to fall. How much is it going to rise? How much is it going to fall? Where do I think it's going to be at any given time? What are my Fibonacci projections? Where am I at in the Elliott wave? What does my indicator say? Because that all has an effect on the price and the value of your options. That's what causes an option to increase in value or to decrease in value, is the chart itself. Now, you have two types of value in an option. You have intrinsic value and have extrinsic value. The intrinsic value is affected by the movement of the underlying market. And that's the biggest moving. I mean, if the market moves, man, that intrinsic value changes a lot. Now, a lot of times there's no intrinsic value. You're trading with options that have no intrinsic value. So all you have is extrinsic value. All you have is time value. All right. And so the movement of the market on time value is very sensitive. Okay. That implied volatility gets very sensitive. And so it's the movement of the market that makes these things go up and down and up and down, and markets go up and down. Do you think the market's going to rise today? Do you think the market's going to fall today? Do you think the market's going to go sideways today? I watched 6 hours of these guys, and not once did they pull up a calendar and show me what the news was for the day. They didn't even care, apparently. I don't know. Maybe they do, and they just did that off screen or something, but they didn't teach it to me at all. They weren't teaching me anything. They were teaching me what not to do is what they were teaching me. So anyway, I watch them to see what they're teaching and see if I can't glean something from some of these guys. But they're also myopically focused on this one little world. They don't see bigger pictures. That's the biggest problem I see with these guys. And some of them have been trading for a while. It's obvious that they've got some experience, but they pull up their spreadsheets and they've got big losers, lots of losers in their thing. And they're having a struggle. They're having that struggle that I told you I've had myself in the past. So I'm not blaming them. I'm not saying anything bad about them. I'm just telling you, don't get myopically focused like some of these guys on the internet, because they're trading options. They're not trading with options. All right. And so what they do is they say, well, I'm going to put on an iron condor and I'm going to trade it, and I'm going to put it in my little risk graph so I can see it all in there. I can see my entry, my break evens. And what they don't show you is the things that they can't show you. What they don't know, right? We don't know what we don't know. And so these are the things that we've been exploring in this class, where we break our risk graphs into two different pieces. I call them right, tickets. I say, okay, we're going to run 2 tickets, or we're going to run 3 tickets, or sometimes we'll run 4 tickets. And so if you're going to run one strategy like an iron butterfly with 4 tickets, you're never going to get a little cute little risk graph. You can't. They don't exist for 4 different tickets, because you're running them 4 different legs, 4 different tickets. That's why I always tell people, when you're trading options, you need to know what each individual leg of that option is going to do when the market rises or falls. Because if you don't, and then you put them all 4 together, you don't know what's going to happen. So what happens is they draw these little lines on the screen, these little risk graphs, and then they have little markers on there that says if it goes beyond this point, this is where it is at break even. So these guys all run in there and they put their stop orders in there. And they say, if the market gets to this point, we're going to stop out. And we lose money. Only to have the market wobble, because that's what it's doing. Wobbles up, gets to their little break-even point. They get stopped out. Market falls, comes right back down where they would have been fine, made money 90% of the time. Why? Because we know this is what markets do, right? We've talked about this at great length. Markets have what we call, I rewrote this for you guys because it was, every time I read it, I was like, it kind of reads funny how I wrote it. So I rewrote it. So this reads better now. And this is what we call the delta cone of probability, right? It's also known as the 68, 95, 99.7 empirical data distribution rule. If you guys want to get a official and, go out to ChatGPT and learn more about it, type that in. 68, 95, 99.7 empirical data distribution rule. Go type that into ChatGPT and say, what is this? And it'll tell you, all right? But it's I call it the delta cone of probability, okay? Approximately 68.2% of the time data falls within one standard deviation. 95.4% of the time data falls within two standard deviations. Nearly 99.7% of the time data falls within three standard deviations of the mean. So it leaves the standard deviation only, again, I should probably change this around. I'm saying how much it's in. I should tell you how much it's out. You got roughly a 3% chance that it's going to leave the third standard deviation. That's what I really want to say. And this is around 95.4%. It stays within the two standard deviations. So you really only have, you put the other side of that, you've got less than 5% chance you got a 95% chance you're going to make money if it stays within this. That's what that's telling you. That's your 68.2% chance it's going to stay inside the one standard deviation. You got nearly a 70% chance of success. Okay. So if you're looking at an option strategy that's a neutral option strategy, or you're looking at an option strategy and you don't understand this concept, which I think they do. I think these guys in these other channels understand this concept because that's what the risk graph is, right? If you take this little picture, this little standard deviation, and you turn it sideways like this, that's what they're looking at, right? They're looking at the standard deviation of this risk graph, and then they got the market moving backwards, sideways, back and forth across that thing, right? Well, markets go up and down, for one thing. They don't go back and forth sideways. So you have to adjust your thought thinking, well, if the market goes up, the graph's going to go to the right. If the market goes down, the graph's going to go to the left. Well, to me, why did they turn the graph sideways? I don't know. They do. So then the graph is drawn sideways. So really the graph is like this. I'm the one that turned the graph sideways. This is not the way nobody else draws their cone of probability sideways like that. They all have them this way. Well, the reason I turned it sideways is because markets go up and down. Markets don't go back and forth from side to side. So to me, it makes more sense. I don't know. Maybe it makes more sense for you because markets don't go like this to me. Markets go up and down. So the cone of probability is up here, right? Is here, and then it goes either this way or this way. To me, it makes more sense. Anyway, so they're trading options. They're not trading with options. I trade with options. So what I do when I come in and I trade, I want to know if I put that right there, where is that in comparison to the underlying market? If I put this right here, where is that in relationship to the underlying market? If I put this right here, where is that in relationship to the underlying market? If I put this right here, where is this one in relationship to the underlying market? Now, I know that when you look at the little risk graph, it shows you where price is in comparison to the delta cone of probability, but it doesn't show you the chart. Nobody ever looks at the chart. That's why I like track and trade, because you can see in relationship to where the market's at. I want to know where my areas of support are. What's the chances the market's going to come down to that level? You don't see that chart. You don't see that line on the screen. You don't, if you're a technical analyst, that's what your whole world is about, right? Trend lines, highs and lows, areas of resistance, areas of support. We want to have our options orders inside or outside of the areas of support, inside or outside. If you don't look at the chart, how can you know where that is? That's why I say they're not trading with options. They're trading options. So I think it's just more information. I think they're lacking information. And then because they're looking myopically at these little charts, if they break it into two different tickets, then they don't have their little chart. And since they don't look at the market and all they have are their little charts, they'll never break them into two tickets. they'll never break it into two little charts because they don't think that way. They don't think biopically, they think myopically, right? So it's just a different way of thinking about the same thing. But if you think about it the way I think about it, in my opinion, which is better, you can look at things in a broader scope. You can look at a bigger sky. You're not just looking at the moon. You're looking at the moon and all the other stars around it. Okay. I don't know if I'm making any sense. I'm just blathering on right now. It's just a different way of looking at the same thing. But because they're so myopically focused on trading that option strategy, they don't see that there's another thing they can do to make it better. And that's what I've noticed when I'm watching them. I'm like, why are you doing that? Don't do that. That doesn't make sense. You can't see it with that little risk graph. Go over and look at your damn chart. You're not even looking at the chart. How do you know that's going to do that? You don't know it's going to do it. You haven't even analyzed your chart yet. And you're trying to trade an iron condor without even looking at your damn chart. And so I just sit there and yell at the YouTube channel all the time. I don't know. I'm not a good student. Oh, glad you guys don't yell at me like I yell at those other guys. So anyway, nonetheless, let's come in and talk about I'm going to drop this down. All right, here we go. So let's see. Let me bring this back down to where we were. Okay, so here's our picture that I want to bring up for your attention. Which one let me make sure I'm in order. So this is the first one. Okay, so this is what we did last week. Now, again, I trade with options. I don't trade options. And maybe that's what I need to just kind of admit to saying. If you want to trade options, go watch those guys because they're trading options. I don't trade options. I trade the S&P 500 with options. Maybe that's it. I just have to accept that that's the difference between them and me. If you just want to trade options, go watch them because they'll show you how to do it. I never do. I'm not going to show you how to trade options. I'm not going to teach you that. I'm going to show you how to trade with options, which hopefully this lecture that I've made has made it clear of the difference between those two. It's a fine line, but the difference is that I know what each individual leg of the option strategy is doing one at a time by itself. And I know why I put that line there. I know why I put that option there, because it's how the relationship between that option and the underlying market is going to react. And I can make adjustments to my individual legs of each strategy because I know what that leg is going to do. And I don't need them all to be on a little risk graph, all mathematically calculated together. I can break them apart and still run them individually and know what they're doing. So that's why I always break things into different strategy, and you can see them down here in the accounting window, right? So the accounting window down here is you can see that I've got them all broken down into different tickets. Now, the reason I did this one is because we had 3 different tickets doing the exact same thing of our strategy, right? Again, I don't know how you would ever do that on a risk graph without looking at your actual chart, but this is what we did. All right, so enough of that. Let's just talk about what we're doing. So what we did is we sold an iron butterfly. So at the money, the body, we sold them, and it's a 0 DTE, so 0 days till expiration. And then when you do that, you need to put your wings on outside as protection. The reason you need to put your wings on the outside is so it significantly reduces your risk. And if it significantly reduces your risk of loss, then the exchange will drop your margin requirement down significantly. So it drops it down from like $12,000 down to $500. Right. And that's a significant drop. Many people might not even be able to afford a $12,000 margin where they can't afford a $500 margin. That's why you put your wings on there. Otherwise, you wouldn't want wings. Why? Because it's insurance and you don't want to have to pay for it. That's the biggest problem with selling iron butterflies. Ask me how I know. I've been there. I've been doing this for 30 years. I have sold more iron butterflies than that tree's got leaves. All right. I have a lot of experience selling iron butterflies. Have I ever made money at it? Yes. Have I ever made a lot of money at it? No. Why? Because the insurance policies always take up all the profit of the sold options. That's why they don't work. That's why they're a pain in the ass. Do they work? Yeah, they work. But they don't pay for those stupid wings. Those stupid wings. If you could get rid of those stupid wings, okay, well, don't put on insurance. Just insure it yourself. You can do that. It's self-insured, right? It's a cash-covered put or a cash-covered call. Well, then you got an insurance policy, no insurance policy, you're cash covered. You have a margin call, you have a margin of $12,000, and you're sitting on this edge of a margin call. Well, that's not good either. So what do? We got to figure out a way to reduce the cost of that insurance, yet still have the insurance. And the only way we can do that is through a process of theta. Theta is the cost that we're paying for. Now, how are we going to do this? You can do it the old traditional way, which is what all these other guys are doing with their little risk graphs. They're doing zero DTE options, so they're selling the zero DTE, and they're also buying their wings zero DTE, right? Zero DTE wings, zero DTE wings, zero DTE bodies. Sell the bodies, buy the wings. The cost of the bodies, the profit from the bodies pay for the wings. Who gets rich? The broker and the guy on the other side, right? That's why that's not a good strategy, because it just doesn't work. And I've struggled with it my whole career trying to make that work. It's in every manual that's how you do it. If you want to read the best manual on options in the whole book, and ask me how I know, I got a whole freaking, you want an options book? I got 10,000 used ones in the other room. They all tell you the same thing. So I stopped thinking like everybody else and started thinking I got to think outside the box. We got to do something different. So what we did is we started thinking we got to break these little butterflies apart. We can't run them like that. That's the way that everybody else does it. And this way I've done it for years. And they don't make money because you got to pay for this damn insurance. So how do we make it so the insurance is a lot less? That's what we have to do. It's not that we can't have insurance. We just got to significantly reduce the cost. So I put on 3 different insurance policies at different rates to find out which one would lose the least amount of money, so I didn't have to pay a lot for it, but yet I still wanted my insurance. So right down here, you can see this is the ones that we sold. We sold the sell, call, sell the put. Right here, you can see it's down $60, $152.50, $212, $212.50, right? $212.50. So that was the money we were collecting. Now the current value, the cost base was $752. So we're going to collect $752 by selling those. Now that's if we let them run till the entire expiration. But markets have a tendency to fluctuate throughout the day, right? We have to wait for the very end of the day for them to make $752. Now here's another thing that a lot of these guys get wrapped up and tied up in. They have these little lines drawn on their chart that shows them where their break evens are or where they're going to start losing money. So if the market goes down and that little line touches that other little line, they get scared and they jump out and they take a loss. So they take their loss. Well, the thing is that when you start to lose money on an option, you're not losing. If you're only losing money if you liquidate your option. Okay, you're taking what the option would have sold for at the time that less money than what you sold it for, right? I don't want to say you're not losing money, because you are. I mean, if you liquidate it, you're going to lose money. You're going to take it off at break even, and that's what they're doing. They're taking it off at break even. But the fact is, you contracted. In this case, we sold a call and we sold a put for $752. So they have to give us $752. That's the rule. They have to give it to us. Now we have to wait till expiration. So expiration in this case is 0 days till expiration. Now, there might be a time throughout the day where had we sold the options at that time of day, we would have made more money than what we did this time of day, the time of day that we sold it for. So it's going to show a loss, but it's a loss against your profit. So you're going to make $752. You could have sold it for $852, which means you could have sold it for $100 more. So as soon as it hits your break even or the loss, right? They want to liquidate it once it makes a loss. What they're really doing is they're saying, I don't want the $752 because I might have to pay $852, which means they're actually only losing $100, right? But that's only $100 against their $752, but their options are not at $752 right now because they didn't wait till expiration to get their full $752. They may only be at $300. Does that make sense? Their option may only be valued at $300 right now. If they waited till expiration at the end of the day, it would be worth $752. But yet it's showing a loss when their option value is only $300. So they make $300 and then it shows a loss, they get out. Why? Because their little risk graph, their little myopic risk graph said that they were losing money. But that was only losing money at that time of day. At that time of day, they were losing money. And it hits their stop because they put their stop in. And sure enough, at that time of day, they were losing money. But they didn't wait to get the $752 because that was at the end of the day. So at the time that it was break even, they were down. They had only made $300 on their option, which was $752 at the end of the day. It's only $300 right now. And so the market moved far enough outside of their little delta cone of probability that at that point in time, they were losing money. So they exit and they get out. And I've done it a million times. That's how I know it's illogical. Okay. Nanu, or whatever that guy did, right? It's illogical. Okay. So I can't go down that road with those guys. So what we did is I put on the insurance policy and I said, all right, here's the insurance policy. The insurance policy, I don't want to have a really super expensive insurance policy that I have to pay for out of the money that I'm making. And so what I did is I say, look, I'm going to take this idea with theta. And I'm going to take this theta idea. Because I know that theta decays like this. Now this says days. I think I got one here. I think I have this in here twice. Yeah, I do. It's right there. So this one is in here. See, this one is a day trading one. Introduction to theta. 7.5 hours, 5 hours, 3 hours, 1 hour. So what happens is the market starts to decay more quickly towards the end of the hour. Now, this is what happens when you're doing it on an intraday, when you have a 0 days till expiration. Since options lose value as expirations approaches, day traders focus on short options with high theta to capitalize on rapid time decay, particularly in the final hours before expiration. If you day trade through the purchase of options, you are fighting an uphill theta value. If you day trade through the selling or writing of options, you have the wind at your back because the market is losing value. Okay. So we bought those insurance policies. So it's like I was saying earlier in my lecture that we have a situation where you have fiat currency. The minute you buy it, it immediately starts to die because of inflation. You want to get rid of that crap. Don't hang on to fiat currency. It's the same thing with these stupid insurance policies that we buy. When we buy an option, the minute you buy them, they start to lose value. So you don't want to hang on to these damn things. That's the problem. That's what the problem that we have to solve. All right. Because this is why these strategies lose money. It's because of this problem right here. So what we need to do is we need to not hang on to, we need to not have insurance during this time frame. So this is the you see how quickly our insurance goes to zero. So if we go in and we buy, in this case, we buy, or we sell the options and they give us $752. Then we go and we buy the insurance policy that costs us, $1,373. Where's the logic in that? Where's the logic in that? Now, I don't have an example of buying 0 days till expiration option, but that's the problem. You sell your options, you collect the premium of $800. And then you buy your insurance policy that costs you, let's say, $750. So your profit potential is basically $50. Now we can get it down lower than that. Let's say it's $250 or $300 profit potential. Maybe let's even say we can get it down to $500. We're gonna or $400. 50% of the value. We're going to lose 50% of the value in theta decay on our options premium. We can't do that. Our little risk graph is going to do that little thing where it's going to draw this little in here and it's going to say you're losing too much money. You got to get out. You're going to hit your stops. And so everybody stops and gets out. And that's why they lose money doing this over the long haul. It's just not good for you. You can't do it. They try and try and try and try and try. I tried and tried and tried and tried and tried. Just you make money out of 10 of them, you'll win. 9 of them, you'll win. And on the 10th one, you lose so much money that the loser wipes out all the profit from the other 9. And that's 90% of all option strategies. So what we've been doing is we've been saying we can't do that. We got to either be cash secured and have no insurance, which we don't want to do, or we got to have insurance that doesn't cost us very much money, but then it doesn't give you very good coverage. So that when the market does go crazy, it doesn't protect you. So what we're doing is we're taking theta and we're saying, okay, we're not going to buy an insurance policy for just the amount of time that we need. Because if we're going to trade 0 days till expiration options, we're going to buy theta for like 20 days, 30 days, 30 days worth of insurance for an option that's for a trade that's only going to last 1 day. Why are we going to do that? Well, we're going to do that because of this theta decay time frame. If we come out here and we buy a theta decayed option that's only got, see how little it moves in the first day? This is 90 days, 30 days, 19 days. Now we're going to buy it at 30 days, 20 days, something like that. But you can see at the very beginning of theta, the decay is very small. See how small the decay is? But in the last few minutes or last few days, the decay is really super fast and very expensive. So what we're going to do is we're going to use the very beginning of theta decay so that we don't have to pay for, we get the insurance, but we don't have the big drop off. And I know you guys that have been here, you know it before, you know what I'm talking about, but we got a lot of new guys in here today. We got a big class. So we got a lot of guys who I'm trying to bring up to speed. So the whole idea here is that we're going to sell those bodies just like we do, just like everybody else does. But we're not going to put our insurance policies on the same risk graph. All right. You're not going to have your second little line. You're not going to have all your little lines. You're not going to have all the little things that tell you where break even is. You're not going to have all your little comfort lines are going to go away because we're not going to put them on the same risk graph. We're going to put them onto 2 different tickets. And in this case, I created 4 tickets, and we're not going to see all of them on one little cute little risk graph that you can sit there and draw your little and push your little lines back and forth and play with that without even looking at the chart. You're not going to have that with this strategy. That's why most of these guys won't do it, because they can't see it in their little risk graph. If it's not in their little risk graph, they won't do it. They can't see it. So they won't trade it, which is good for us guys who don't do that, right? We're just going to take their money. That's what we're going to do. So that's the whole name of the game. We're going to take their money because they're going to do it the old way. We're going to do it the new way, and we're going to take their money. So that's what we are. We're thieves, right? We're here to steal. We're going to steal from the guys who haven't thought through this far enough. So what we did is we put on 3 different insurance policies at different rates to find out which one would be better. Cheaper is really what we want, right? We want our insurance coverage, but we also don't want to pay for it. That's the best kind of insurance, right? So we want very small time decay. So in this case, these were all set in here at, and if I remember correctly, we put them all on at the monies. Didn't we put them all on at the monies? These are all at the monies. Let me double check. 520. Yes, they're all at the monies. Because the last example, if you guys who are new here want to see the last example where we all put them at delta 20s, all at delta 20, but with different time frames. That's in last week's video where we did that on, was that Thursday? I think last Thursday. So if you want to go see that one, go watch that video where we did 3 insurance policies, broke them apart. They're not all on the same risk graph. And we looked at 3 different insurance policies to see which one would be the least expensive. We put them all on delta 20, but we had different theta. This one, in this example, we put them all at the money. So we put them at the money and we put them all at different theta. And you're like, well, wait a second. If you're going to sell premium at the money and collect premium, have a sold call and a sold put, you can't put your insurance policy right on top of it because it will liquidate the position. Again, another reason why these guys who look through their myopic little thing and are trading options, they're not trading with options. They're trading options. They're not trading with options. They can't do that strategy because they can't see that with their little risk graph. All right. Their little risk graph, they have to all have the same expiration dates. So what we do is we sell the bodies with a 0 days till expiration, and then we sell at the money the same bodies, but we sell it, in this case, we do it 3 days out because we had a weekend. We just want to do it the very next day. So if we're going to do this, we want to do it like on Monday and have our insurance expire on Tuesday. But that's going to be at the money. We're going to show you the difference. Then we went out and we said, okay, now we're going to do it at the money, but we're going to go out 7 days. And then we did at the money. We went out 21 days out to the quarterly. Now we could go out even farther, but the farther you go out, the more insurance you're going to pay. But the difference is, look at the difference in the cost of the insurance. That's what I'm trying to get to with this particular picture. The total gain. This is down here. The 3-day insurance policy, we actually made $50 at this point. The 7-day, we were actually making $25, and on the 21-day, we were making $12. And you're like, well, the shorter one is better. That's better insurance. It's true. And it costs you less. $5,300 is what we paid for that insurance policy that expires in 21 days. And you're like, Lan, why would you buy a 21-day insurance policy if you only need it for 1 day? You don't only even need it for 1 day. You only need it for 1 day, but you really only need it for one trade. And one trade, we might only be in it for a couple hours. So why would you buy 21 days worth of insurance if you only need it for a couple of hours? Because the time decay on it is almost nothing. So you get it for free. That's basically what we're doing. But we have to put up more money. Now remember, as no options, no insurance policy was like $12,000 in premium, right? Well, if we put on a 21-day insurance policy at the money, it's $5,300. So we're halfway there. So if you're like, well, I might go out 60 days so I can really have no time decay. Well, at that point, you might as well not have any insurance because it's the same. Other than the fact that, well, you have your insurance. So you need your insurance, but you're going to pay the same as if you were cash secured. So there's a point at where your insurance policy becomes so expensive trying to eliminate the theta, the decay, or the time decay, that you might as well not have insurance because you're cash covered at that point. All right. Does that make sense? So the next one is at 7 days. And at 7 days, we paid $3,362 for that insurance policy. And we made actually $25 at this point. And then this one here, we made $50 because the market started to move. And so what these really are is we're playing straddles and strangles, right? That's what we're really doing. We're playing straddles and strangles. That's all an iron butterfly is. That's all an iron condor is, just a couple of straddles and a couple of strangles. Well, this one here, we did 2 straddles, right? No, strangles. Sorry, get them mixed up. So we just did 2 strangles. We did a 0 DTE strangle that we sold, a short 0 DTE strangle, and then we did a long 3 DTE, 3 days till expiration strangle, right? We did a long and a short right against each other, and that's what we're really testing. So if it comes right down to brass tacks, that's what we're doing. We're doing calendar calendar. Let's give them a name. Calendar strangles, right? So one of them was calendar strangle, where we sold and we bought with 3 days, 0 days till expiration in 3 days. And then the other one was 0 days till expiration in 7 days. The other one was 0 to expiration is 21 days. And so that would push your little wings way out. And then your little break-even points would go way out, but they would be wrong because they would only calculate it for the 1 day and they wouldn't give you the credit for the whole outside. That's why I put them on 2 tickets. And in this case, I put them on 4 tickets so you can see them all independently. So the 2 insurance policies, which are on 1 ticket, two options on 1 ticket, this is what it gave you. The cost basis was $3,000 and we made $25. Now, that was the very first. That was just the short period of time that we put it in. So let's come in here. And the next one, you can see, this is where we came in, and this is where we have our, okay. So what happened is I took one off at the profit because we take them off at 25% profit and then we reset them. So we reset them back into the center of the cone of probability. So that one there, then now we're up $85 on this one, and our insurance policies are what we're really concerned about is 87, 87, and 102. So we're actually went from making money on our insurance policies to our insurance policies losing money. Which one lost the least? That's what we're most interested in. We want to know which one of these insurance policies lost the least dollar amount, not percent, dollar amount, because that's what's going to have to be paid with our 0 DTA profits. So we had 3 expiration until day. That one lost 102. The 7 lost 87, and then the 21 at this point was down 87.50. So you can see our 7-day till expiration and our 21-day expiration lost the same dollar amount at this point in time. All right, so let's get rid of that one. Go to the next one. Here's the next one. So now we're up $127 on our position on the sold puts and calls, 0 days to expiration. This is further throughout the day, further into the day. So now you can see our 3 days of insurance policy is down 117. Our 7 days is down 100, and our 21 days is down to 100. So the 21 and the 7 are about the same again, and we're up $127. But we have to pay for that insurance policy. Now, we don't have to pay for all 3. We don't have to buy 3 insurance policies. We only have to pay for one of these. What we're trying to decide is which one do we want to pay for. So when we put it on again today, we can say, well, I'm not going to put on all 3. I don't need all 3. I only need one. Which one am I going to put on? Am I going to put on the 21-day? And I'm going to put on the 7-day? Or am I going to put on the 3-day? Which one's going to lose me the least amount of money? Well, and you have to also take into consideration if the market takes off and goes to the moon, well, the one that's going to work better for you is the shorter term time frame, right? It's going to be more volatile. It's going to cover a little better based on the amount of money percent wise that you put in. You only put in $1,300, right? This one you had to put in $5,000. This one lost $100 against $5,000. This one lost $117 against $1,300. So the percent is a lot different, but the dollar amount is what we're mostly concerned about in this case. So that was that one. Let's look at the next one. This is the next set that came up. So we have, this is just the insurance policy. So we took that second one off, banked that profit, and we ended up with, at this point in time, you can see the market's moved forward a little bit. The 21 period moving averages are losing 112. The 7's 112. The 3 is down 167. So the 3 period moving average is down. It's losing more than the others. We have to pay for that. We have to pay for that. So let's go to the next one. So the next one, I closed out so you can see the profit. So we took off the 2 here, took off the 2 here. That was just another thing we were doing in the S&P, so that doesn't count. So you can see we lost on 115, but we made 310. We lost 25, we made 17. Now, one of the things I did, I legged in and legged out. I can't remember, was that last Thursday I legged in, legged out or was it this one? Let's go to the next one and see. I think we talked about legging in and legging out last week. I don't think I legged in, legged out this time. All right, this is another thing that these guys don't ever talk about in their little risk graphs, doing the way they were doing it on the YouTube videos that I watched. None of them talked about legging in, legging out, and rolling. Those are more advanced strategies, but I think when you're going to do this, you got to take that into consideration, or you're going to be leaving half the money on the table. All right. And it could be the half that's going to make it profitable. So we have to talk about that. All right. So here we are. We put the third one back on. So now we got 3. Now remember, we buy the insurance policies and then we never take those off. We have the options that we sell at the money. And those are the ones that we take off every time they make 25%. So we've been taking them off at 25. You can do 50. You don't have to take them off at 25 either. If you're sitting here watching it and it's still dead center of the cone of probability, don't take it off. Let it run longer. The only reason you take it off is because it's starting to leave the cone of probability. And you're worried that you need to recenter the market over the top of the cone of probability. Take your profit off, recenter, and do it again. Don't take off your wings, though. Don't take off your insurance policies because that's going to cost you a commission and a spread. So at this point, we're up $55. And then we come in, we got 3 days. Now it's down 205. Now this is a 3 days. If you're doing a 1 day, it's going to be more than that. You're making 55 plus the profit of the other 2, but now you're down 205 on your insurance policy. You see how this is working? You get 7 days, you're down 125, and 21 days, you're down 125. So you notice that the 7 days and the 21 days right now at this point in time, they're still almost exactly the same, aren't they? It's not doing us any advantage of putting up 5,300 versus the 3,300. But versus the 3 days, the 1,300, it's making a big difference between 125 and 205. And if that was 0 days till expiration, that thing would be really choking us. And that's why these things don't work when you do 0 days till expiration on both the wings, the insurance policies, and the bodies. That's why you have to break them apart. All right, put them on different tickets. Don't have your same little myopic little risk graph. Trade options versus trading with options. All right. So there's that one. So it ended up, let's take that one off. Go to the next one. I got 2 more. All right. So here we go. One more. So now we're up $92. We've still got a cost basis of 463. So they've given us 92 out of the 465. Now, this is another place I think these guys are going wrong. Because right now we're up 92.50. And if the market moves far enough to where they start to, it shows their break even is to start losing money. They're calculating that against their current profit of 92.50. They're not calculating against the 465 at break even. Now they might be, but it didn't look like to me that's what they were doing. The market was we have a $92.50 profit. And if the market moved to a point where that 92.50 went back to 0, they got out. They were getting out. They were putting a stop order in there. What they weren't taking into consideration is that they still had $390 sitting on the table. So they would get out because they lost their $92.50. Not taking into consideration, they still had $390 sitting on the table if they would have just waited longer time. But they didn't want to wait because there was a chance it could have lost a penny or two or a dollar more, $50 or $20. They didn't want to risk $20, $30, $40, $50, $100, $200. How much are they going to risk before they get out and take the loss, right? Or have the market come back into the cone of probability, which we know is like almost 70% of the time it's going to do that. And it's going to only go into the tube, the second standard deviation almost 95% of the time, right? This is where you roll. This is where you leg out. So I'm going to teach you that in just a second. Let's finish this. So now we're at 92, and our insurance policy is at 190 for the 3. For the 7, it's at 137, and the 21, now the 21 is starting to show its advantage. It's at 125. All right. Now you put up $5,300 versus $3,300, but as more time goes by, the theta decay on the 7 is going to be greater than it is on the 21. Not by much. At this point, it's 25 to 37 versus this one here, the 3, it was already 190. And you can imagine if we were doing a 0. You can't do 0 on top of at the money. The best you can do is 1 day. But this is 190. This is 3 days. So it would have been worse than that, worse than 190. All right, so let's close that one. We'll do one more. So 21 days. This is the last picture I took. So we're getting towards the end of the day. This is like, you can see down here in the chart, it's at 1 o'clock. This is 1. It's 1 o'clock. 1:50. So it's almost coming into 2 o'clock. That's 1:30. This is 2 o'clock. So it's a quarter after 1 probably. So at that point, we're up $100 on our sold options. So our profit is at $100. And then our 3, we're paying $282 for that insurance right there. So the 3 days out at the money costs us $282. The 7 days out costs us $175, and the 21 days out only costs us $150. Now, we did win 3 times, but we had to pay insurance. Which one do you want to pay? Do you want to pay the $282 insurance policy? Do you want to pay the $175 insurance policy? Or do you want to pay the $150 insurance policy? So more time further out in the delta is what we've learned, right? It proves out exactly what we kind of figured it would, but we wanted to have empirical proof. We have empirical proof. We actually went out and proved it to ourselves. If you buy you buy more time and less insurance, you're going to have a less of an expense. Okay. So the name of the game is trying to gauge how much insurance you want to buy based on what you think the market's going to do. So you got to do your technical analysis. You got to be an analyst. You got to be able to pick market direction. You got to have an idea of whether that market's going to burst out and run today or not. You got to look at your charts. You got to look at your daily charts. You got to have an idea of whether that market's going to be up, down, or neutral, right? You got a 33% chance of being right. Either that market's going to rally and go, or it's going to fall, or it's going to go sideways. This is an example of where you want to make money when a market goes sideways. And then you have to have your insurance premiums out there, but you want to pick the day that you think is going to have the least movement in the market and buy the least insurance. If you think there's going to be a big market moving day, you're saying, well, I'll just buy more insurance. No, on that day, you shouldn't probably even trade it. Don't trade a neutral strategy. Again, you've got 3 things that the market can do. The market can go up, the market can go down, the market can go sideways. You want to trade this strategy that we've been playing with for the last 2 weeks and perfecting, and you only want to do it when the market is probably going to be neutral. And you want it to be neutral for basically the whole day. You want it to be a neutral day. You don't want it to just be a neutral 10 minutes because you need time decay. And time is how you get paid off. And then that's what also costs you the expense of your insurance policy. It's the insurance policy that is the expensive part of what's going on, right? You have to pay for that insurance policy. So if you don't want the insurance, you don't want to pay for a high insurance policy, buy a cheap insurance policy, but do it when there's nobody riding on the road. So you don't have to take a crash. You don't have a high probability of getting in an accident. And that was a long lecture for that summary, but hopefully drove it home. Sometimes I drive things home. I'm very good at using a paragraph when a sentence will do. How come? All right. So that's that one. Let's go over, and I guess that's probably, I've kind of wore out my welcome. I guess that's all I got for you today. I got a Sunday school lesson for you. Let's come in here. I've given you enough Sunday school lessons, I think. I don't have a Sunday school lesson for you. I don't have my Sunday school lesson pulled up. Let's just end it here. I think this is good enough. So we'll just give you a real quick summary. Markets can only do 3 things. They can go up, they can go down, they can go sideways. We make money, buy contracts, buy shares, buy calls, sell puts. That's how we make money when the market goes up. When the market goes down, you can sell contracts, you can sell shares, you can buy put options, you can sell call options. That's how you make money when the market goes down. When the market goes sideways, you want to sell your calls and sell your puts. And today we kind of had a really strong lesson just on theta, premium, multiple. Look at things from multiple standpoints. Don't get so fixated on just one thing, and push those time frames out into the future. Buy the least amount of insurance as you need to, because that's where it's going to eat up all your profits and make your strategy whether it's going to be profitable or not. And I guess I'll let you go with that. If you thought this was helpful at all, I know we kind of went long and I repeat a lot, but if you thought that was helpful, go ahead, give me a thumbs up, and we will catch you guys again tomorrow. And Didn't have a chance to go put a new one on today, but I'll probably go do that now, and we'll let you know how it turns out. How's that? Okay, guys, I'm going to let you go. We will see you tomorrow.